Hey guys, it's Scott here. Now we sometimes get the question, why has Freedom Property Investors recommended that we invest in an area that has not had much recent growth in the past? Now this is actually a good question, and to answer it, I actually just want to educate you a little bit more about how the property market works. So the first thing that I want to show you is this. The median growth rate for Australian property over the last 25 years is 6.8%. So 6.8% is very close to 7%. If you get 7% per year annual capital growth rate, then in 10 years, your property will thereabouts double. It'll basically double in value. So 6.8% is the target. We don't want to get anything below that, but we want to get at least 6.8% and above. Now remember that 6.8%, that's actually the national number all across the country. It's including all of the low growth areas. It's also including all of the high growth areas. So we can increase the probability and increase the chances of getting above 6.8% simply by coming to the east coast of Australia and investing in the capital cities there of Sydney, Melbourne, and Brisbane. And you can see here that Sydney, Melbourne, and Brisbane actually have an average capital growth rate higher than the 6.8%. Melbourne being the highest, and Sydney and Brisbane coming in about equal. So over the long term, this is actually based on about 38 years worth of data. We've actually got these particular numbers here. Now, to know more about it, you've actually got to also understand the rule of 70-30. So I want to just find the chart on this rule. Here it is here. Actually, we've got a better one here. If I can find it. Here. Okay. Now you can see here, this is just data. It's not going back that far. We're just going back to the year 2000. But as you can see here, property moves in cycles. So what happens is the property market grows, then it goes into contraction, then it plateaus, and then it grows again, and then it grows again. And what can actually happen is it stays in this period of a non-performance for quite some time, for about 70% of the growth cycle. But just in 30% of the growth cycle, you can see here from 2000 to 2003, just in 30% of the growth cycle, we've had over 70% of the growth. So when the growth comes, it comes in spurts. So the long-term growth rate is 7% or above, but that 7% is not coming every single year. Now, let me ask you this question. If you were an investor and you were to look at the growth chart in Sydney, for example, in 2004, and if you looked back into the history of Sydney, 2004, 2003, 2002, 2001, you would see a history of really, really great growth. Now, you're sitting in 2004. Now, would it be a wise thing to invest in Sydney in 2004 based on the past track record of really strong growth? Well, we've got the benefit of hindsight here, and we can obviously see that that would not have been a good decision. That would have been a bad decision. Now, if we can come over here to about 2013, 2014 of Sydney. Now, if we were sitting here in 2013 and we were to look back at the data, the last 3, 4, 5 years of Sydney before 2013, it would have shown flat growth. In fact, if you can look here at 2011, it would have actually have shown negative growth. So sitting in 2013, using the logic that, hey, it hasn't really grown in the past, the recent past, using that logic, you may not actually invest in Sydney in 2013, but that would have been a great, great move. Now, Liana, for example, went out and bought 8 properties in Sydney in 2013, even though Sydney had not had any growth going all the way back pretty much to 2004. Basically 9 years of no growth, not a lot of growth, non-performance. So you've got to really think about that. So if you were sitting in 2018, you would look back at the recent history of Sydney and think, wow, there's been a lot of growth. Sydney must be great. But you would have been wrong. And this is the problem that so many rookie investors make. They want to see 4 or 5 years of growth, then they want to invest. The problem is that you're investing at the wrong time. The wrong time. Now, the fact that a really great market has not had growth for a really long time is a very good reason why you should be interested in finding out more about that area, because that area actually has the most potential for growth. Now, you can see here, you look at Brisbane in 2019, there has not really been a strong track record of growth preceding it. In fact, there's actually been some negative growth here, a bit of a dip here. And if you were to take the logic that because there's been no growth in the past, there's going to be no growth in the future, you may actually miss out on the huge growth that's going to come in Brisbane into the future. Now, you can see here, this is the Sydney versus Brisbane price gap. You can see here, this is the gap between Sydney and Brisbane at this point in time, back in 1980. And you can see here that the gap is about 110%, meaning that the gap between Sydney and Brisbane is really, really big. But then look what happens in a very short space of time. In only 2 or 3 years, the price gap between Sydney and Brisbane shrunk. It shrunk because Brisbane caught up. It caught up. And then what happened is we go along to about 1986, 1987, and then Sydney prices shot off again. And the gap went back up to about 150%. So Sydney shot up. Now the gap's about 150%. But the gap closed again. You can see here, over about 3 years, what happened was Brisbane shot up again. So this graph is showing Sydney growing, Brisbane growing, Sydney growing, Brisbane growing, Sydney growing, Brisbane growing, Sydney growing, Brisbane growing. It's a repeatable pattern. Now, if you can see here, the gap peaked about here, and now the gap is closing. The gap is closing, of course, because if we go back and look at the data, you can see here that Brisbane has been growing and Sydney has contracted a little, because you can see here that Sydney does go through some very small contractions after a long growth phase. So it'll grow, it'll contract, it'll go flat, then it'll grow. So you can see here, it'll grow, it'll contract, it'll go flat, and then it will grow. But during that time, Brisbane has always in the past, has always caught up and always closed the gap. So the data here suggests that if this line continues, continues in its current trajectory, and if it winds up somewhere down here, what that will mean is that this grey line here for Brisbane will have to increase, and anyone who's invested in Brisbane during that time will make substantial gains. Now, where in Brisbane do you want to be? You want to be in a blue chip area. This means you want to be within 25 to 35 minutes of the CBD. You do not want to be in Ipswich. You do not want to be in the areas between Brisbane and the Gold Coast. You do not want to be there. You do not want to be way up north outside of Brisbane, 40 minutes, an hour away. You want to be in and around Brisbane Metro, within the Brisbane City Council. You want to be within 25 to 30 minutes, and you want to stay away from the areas in Brisbane that are oversupplied or have a low socioeconomic, high unemployment area. So if you eliminate those areas, you're left with about 10 areas. Now, what you then want to do is find the best properties in those best areas and find the areas that are going through gentrification, but also have very low supply. So if you get rid of the areas that can have lots of apartments and those types of things, again, you can narrow those areas down. We've got around 5 or 6 areas in Brisbane only that we recommend to invest. They're the only areas that Liana and myself and our whole team are investing, and that's why we're investing in those areas. Remember that the majority of the capital growth that comes for a property will be because of the location that it's in. Then, of course, you want a quality property that downsizers want, that young professionals want, that multifamilies want. You want it to be unique and rare. You want it to be high quality. But most importantly, you want the cash flow to be very, very positive. And you'll find that with all of our property recommendations, the cash flow on them is at least at a yield of 4, 4.5%, 5%. So I really do hope that this helps with your understanding of the market and when to invest, why to invest, and where to invest, and why Liana and I are investing in these specific areas. Thank you very much for your time.